Yeah. Hi, good morning to everyone. And in this presentation, I'm going to talk about asset management. Before that, I want to give a little bit of introduction about myself. So, my name is Satya Prasad, and I born and brought up in Chaudupal, which is just outside of Hyderabad. And I come from a family of five, and my father and my two elder sisters are working professionals. I have graduated from in the year 2022 in computer science and engineering degree from Satyabama University, Chennai. Yeah, my strengths are I'm confident, energetic, and my interpersonal skills such as communication, leadership, critical thinking, and networking. So in this SIBA program, I came across different domain skills like what is financial system, who are the participants, what are the products involved in financial system, and also how to do back end operations of this kind of products, like how to go through the trade or how trade goes on, what are corporate actions, what is AML KYC, and those things. And my goal of joining this program is to get into an investment banking firm where I can put all of my uh, theoretical skills into practical use. So that is my goal. So coming to my second thing, why did I choose IB? So it all started with my curiosity to understand how land prices are working, what is the basis behind those things. Actually, when in the past, my family members and mostly in Telangana, there is a lot of positive sentiment in the market about what is land investment, how their valuation are easily skyrocketing year by year. But I didn't understood why they are appreciating like that. With year on change, they are appreciating more than 50%. And my family members, they put most of their wealth in those land investment only. So I want to understand how this pricing mechanism is going to work, and so that if I know those things, I can make my own investments, so I can learn more things on that. So then I've started my research, and after doing my research, I came across a lot of different products and larger and more influential and more valuable products like investing in companies like bonds and everything. And I understood that these kind of investments like financial instruments like stocks and bonds are their value is totally dependent on how much they are earning, like how much cash flow they are generating in the future, and their position in the market. And I thought that they are more predictable to do some kind of valuation on those products compared to these things. So I started dwelling more into those topics, and then I came across a inspiring investor called as Warren Buffett, and he's the world's biggest investor. And his way of teaching and his strategies that he used to invest in companies and how he's going to make investments. So I like the idea, and so I want to learn those skills. But as my background is not from finance, I can't able to get into a firm or a field where I can learn these things in real life and practical use. So I thought that there should be an institution where I should get some kind of training on all this kind of domain skills, and also some professional skills like soft skills where I can where I can develop my communication and so on. So I found out this SIBA program. I joined this program, and this is going to I've learned a lot in this program. So that's why I choose an IB. So coming to the topic today I'm going to discuss about asset management. So first of all, what is asset management? Asset management is nothing but managing people's money. So asset management is managing other people's money is called as asset management. uh, they will pool money from investor and develop some kind of strategies to create value to the investors that they are pooling money from. So why they will do this, because people, why we need this kind of institutions like asset management is because Some people, most of the people in the market are, they don't know what how to make investments on their own, because they don't understand how these instruments is going to work, and how to find good companies that are that give good kind of return, and also which protects themselves. So then for them only this kind of asset management serve them by pooling their money and making investments on their behalf in a manner that is going to give good returns to them in the future. That's what asset management is all about. So the company which manages this kind of assets by pooling money are called as asset management companies. Some of the biggest companies in the market are Vanguard and BlackRock. So in asset management, we have total three topics. First is portfolio management, second is mutual fund and hedge funds. So coming to portfolio is management is nothing but managing individuals or organization money to reach their long-term financial objectives, such as retirement planning or funding a new project. Those things is all about portfolio management. Like they have savings with them, and in future they want those savings to fund their needs, such as if a person is doing job now only is going to earn. In future after retirement, he will not have any source of income. So to protect himself in the future when he does not have this kind of source of income, he will plan from today itself by putting those savings into assets or different kind of portfolio, like investing in stocks, bonds, and those things. To in the future he will get good amount of money by investing some lower amount now, and it can fund his day-to-day expenses, and also he can live a stress-free life in the when he gets retirement. Yeah, that's what portfolio management is all about. In portfolio management, there will be professionals who will look into a person or a organization structure and identify his risks, his goals, and how much monthly expenses they will plan overall, and they will suggest different kind of, they will totally divide those all the money that they have into different asset classes based on the goal that they want to reach. And insurance products such as health insurance is also comes under portfolio management. So it's they will protect themselves from downside risk by this by investing in this kind of products, like not investing, by buying this kind of products like insurance. Coming to the next topic, so it's mutual funds. Mutual funds are nothing but they pool money from individual investors or multiple number of investors, and they invest those money into financial securities or diversified pool of securities like stocks, bonds, and other securities to generate a return for the investors that they are pooling from. And first, here are the some basic features of mutual funds. Are they it is a pooled investment structure. So individual investors contribute some kind of amount to the fund, and they will lot of individual investors, by contributing small amount of money, the fund will invest all of those money together into a diversified products, and they will generate across all of the products, like it is called as diversification. So the return that they generate on all of the products that they're investing, they will not invest in a single company. They will take, let's take, if a fund is focusing on S&P 500 or Nifty 50, then the fund is going to invest in all of the 50 companies that the whole money that they have pooled, they will invest that money into all of these 50 companies. And in case if some companies is perform better and some other companies does not perform better also, then they will get some kind of even returns, and it will protect themselves from if a company performing overly well, because some companies not perform well, so it will protect themselves from those kind of risks. And third is professional fund management, and the fund is totally managed by a professional fund manager, and they are totally fiduciarily duty, like they are lawfully abide to put their investors or fund investors interest first, then themselves. And fourth is liquidity. As you know, this units actually we will get into how this units comes into, like with the help of NAV calculation. But what liquidity is all about. If an investor wants to exit the funds, they can exit on each and every day. Like there will be not a day that you should there will be no locking period. Like any time if you want to exit from the fund, anytime you want to convert those your money into a cash format, then you can simply do that by trading those assets and it can be traded on each and every day. So there are two types of mutual funds here. First is open-ended mutual fund and second is closed-ended mutual fund. In open-ended mutual funds, investors can buy and sell those units at any time. The fund will continually issue and redeem those securities based on investor demand. If more people wants to buy those funds, then the fund like open-ended funds, they will issue more units to the public. And if the investors who bought those funds want to exit more, then they will simply liquidate the assets based on the investors demand, and they will set off those amount by reducing the number of funds that are available. And the prices of the fund is calculated by using NAV, and they are calculated daily, and we will able to know this NAV in the further presentation topics. Second are closed-ended funds. These funds have fixed number of shares issued at initial public offering. So they are very similar to company issuing their shares to the public at the first time. This closed-ended funds only issue their shares or the only raise money once, and they will only invest the raised money in the assets, and they will generate some returns. And the people who bought those shares, they can able to trade like a stocks in a secondary market where they can able to trade those shares to other investors, those things. And the prices of those shares will be dependent on market demand and supply. Like if more people willing to buy those stock share, then the value will increase. Yeah, that's what this is all about. So the organization structure is: first, there will be a fund manager who is the sole responsible to make investment decisions. Second, trustees. They safeguards investors' interest. Third is custodian. They are old and safeguards funds assets by yeah. So there will be agents. They will promote and sell those funds to investors. This is the organization structure. And coming to the next topic, there are hedge funds. Hedge funds is an investment pool that pools money from only accredited individuals or institutional investors, and they will employ different kind of investment strategies like derivative trading, complex tradings, to generate a return that is more than the market return to its investors. That's what hedge fund is all about. Unlike mutual funds, hedge funds are subject to very few regulatory restrictions, and they can get their hands into more complex and high risk investment strategies, such as short selling by using a lot of leverage and derivative trading. They can use this kind of things. So here are some of the features of these hedge funds. They are considered as high risk, high return kind of products. They pursue very highly risky strategies to generate very high kind of return. Those things. Second is limited regulation. They have very fewer regulations because the investors that they are investing in their funds are already people who have good amount of are financially well sounded, and even if they lose that money also, then the people will not the investors will not able to they can manage, they can take that kind of risk. Those people, because of those things, the regulators will allow themselves to use whatever strategy they want. And third, they will use lot of leverage and derivatives. Leverage is nothing but by investing small amount of monies, we can able to get lot of exposure by the way of debt, or by the way of by using derivative products such as for futures, options, and those kind of products. And those things they can do. Fourth is the performance fees. In hedge funds, they will in industry standard they will call as 2 and 20. So 2% of all the assets that they are managing. Let's take Hedge fund is totally collected money from investors and managing 100 rupees of funds, and then yearly the fund manager or the fund will charge 2% of those 100 rupees, which is 2 rupees. And also, in case after 1 year they invested in different kind of products and generated around let's take another 120 rupees as profit, and now on the 20 rupees they will collect another 20% of profits. 20% of 20 rupees is 4 rupees. Totally they will collect 6 rupees of fees from the investors by totally managing 100 rupees and 20 rupees as return. And here are some of the types of hedge funds in the market. First are equity hedge funds. They will focus on equity markets. Second are event driven kind of hedge funds impacting markets such as let's take COVID and so on. Third is macro hedge funds and value hedge funds. Yeah. So here are some organization structure of typical hedge fund is there will be a general partner. He will be the sole responsible to make investment decisions. Second, there will be limited partners. Limited partners are people who are investing money into the fund are called as limited partners. And third is fund administrator, handles back he will handle back office functions. And prime broker they will services like clearing and settlement. And compared to hedge funds, what the major difference between hedge funds and mutual funds are? Here are some of the differences. So they will the main difference lies in this kind of things like what are the objective strategies, investor base, and regulation. First, investor base. Mutual funds, there will be wide range of investor base, and most of people who are investing in this kind of mutual funds are called as retail investors. Retail investors are people who have less amount of money and mostly investing money to reach a financial goal in the future, like a retirement, like planning for their children, those kind of things. And mostly they have long term horizon, long term goals. And second are hedge funds. In hedge funds, it's more like a profit making kind of thing, not to plan something. They don't want that money for a specific kind of purpose or like a retirement or anything. They just want it to be grow as much as possible. And even if they lose that money also, then they can manage themselves without any financial risk to themselves. They will only serve to people who are very high net worth individuals like HNIs and institutional investors, or people who have sophisticated financial knowledge, those kind of investors. And second, regulation. Mutual funds are highly regulated. They are regulated mostly because the people who are investing in those funds are regular people like retail investors, and for them, that money that they are investing, they are very valuable to them and very important to them. And in case it is not regulated well and any kind of fraud, something has happened bad to this kind of investor, retail investor, then in future they will not trust to invest their money into these markets, and it is going to give very long term effect to the overall economy. Like there will be no people who will give funding to them, and it will be very hard to cope. That's why there will be a lot of restrictions put place on these mutual funds. And in USA, typically Securities Exchange Commission will look into these things. In India, uh, like SEBI. In India, SEBI will look into these things. And hedge funds are not regulated at all, and there will be some exemptions to them. Investment strategies. These mutual funds mostly invest in traditional assets such as equity and fixed income securities, and their whole goal is to get long term wealth for themselves in the longer term. And these hedge funds are they will use different kind of investment strategies, and their whole goal is to get as much as profit in lesser time as possible. And whatever the market conditions, they only want themselves to make profit, those things. And risk and return mutual funds are considered as very lower risk compared to hedge funds, because these mutual funds use the concept called as diversification, where they will invest all the money into different kind of companies, different kind of stocks, not in a single stock. So in case one company does not perform also, the other company's investment will manage the risk, and overallly they will protect themselves. And when it comes to hedge fund is kind of a sure bet. They will not use these diversification strategies. They will only choose one kind of investment, one kind of product, and they will bet all of their money with a very which has very high risk, and also which gives very high return kind of products in any type of market conditions. And liquidity, when it comes to liquidity, mutual funds are considered as highly liquid, and they can able to easily liquidate their positions or square up their position daily by using NAV. We'll get into NAV. In hedge funds, there will be certain restrictions like lockup periods where they cannot withdraw their funds in the time period. So there will be some kind of terms in mentioned based on the agreement when they invest into the funds. In the fee structure, mutual funds will charge under asset management, and they will charge minimum amount of charges, but this hedge fund will charge higher amount of amount. The transparency, when it comes to transparency, these mutual funds have very high transparency compared to hedge funds. Now, the last and topic, we have fund accounting. Wow. In fund accounting is nothing but accounting for the accounting used to for mutual funds and hedge funds, mostly accounting method used in investment funds. The purpose is to provide transparency to investors so that they can able to clearly know how much the fund is performing, how much their investments is performing in the market on daily basis. So this is what they will use. So they will use this kind of accounting concepts like they will daily update those things using different kind of accounting methods, and they will use this kind of gap principles. And this is important. Accrual accounting, in accrual accounting they will recognize revenues and expenses when they are incurred, regardless of when cash is received or paid. Let's take there is a rent. Let's take you are a company, and you are going to pay rent each and every month, and but the rent is expensed on the first day itself, but the payment that you make, it can be after 5 days, after 10 days of the starting month, but the rent is already expensed on the start date. That is what accrual accounting is all about. Whenever the month ends, the company or the accounting department directly considers the amount is already paid by way of accrual, like they will consider it at expense, and after 10th date they will manage those both of things and make it as real expense. So that is what accrual accounting is all about. It gives a uh, it gives relative matching and offers a clear view of what is going on fund performance. Second topic is calculation involved in this asset management, fund management. First is gross asset value. Gross assets value is nothing but total value of fund uh, before any fees and expenses. Like they will take all the market value of all the assets that they hold and the cash that they have, and they will take this and minus their liabilities. That is what GAV. Coming to NAV is nothing but this is called as net asset value. It is most important thing when that a investor should know before investing in mutual funds. It gives a per unit value of their ownership that they invested, per unit amount of value, in per unit value. We will get this by using this formula like total number of assets that the fund have. It includes cash and receivables and everything, minus fund liabilities like fund manager fees, brokerage fees, advisory fees, so on, divided by total number of units or total number of shares that are available. And we can able to get NAV in per unit value. Let's take NAV of 200 rupees per unit value. Those things we can get, and it gives a clear understanding to investor, and the investor can able to easily know how much money is making and how much money he can able to get out of money if he wants to return, and gives a clear and transparent way. Yeah, so that's all from my side. So if you have any doubts, feel free to ask me. Yes, sure.
Satya, what is that asset under management?
Yeah, assets under management is all about how much of assets they are managing. Like, let's take, there is a company called as BlackRock. BlackRock is the biggest company, and they will. Here it comes, right. Yeah. So they will take, like, they have total number of assets. Let's take, they have collected 100 rupees, and in the starting case the assets under total management is 100 rupees, and after that 1 year 2 year the asset will improve it, right? So how much value of assets that they are managing in case of market cap, how much value of assets they are managing by getting the market cap of all of those assets is called as asset management, assets under management.
Okay.
Yeah. Any other question, Joshna?
No.
Okay.